We've already had a couple of comments regarding the IFRS, the International Financial Reporting Standards, and the proposals that are in front of the accounting community and financial community. If these standards are adopted, how do you think this will impact on product pricing and product features? Paul, we'll start with you.
Well, first of all, I think it's important to recognize that IFRS, we already have IFRS in Canada. Public companies, or what they call nearly public or something, whatever that means. They had to adopt IFRS in January of 2011. So our firm, for instance, which is Guardian Capital, is a public company, they implemented IFRS as of January 2011. It was really a replacement for Canadian GAAP. So that was an accounting change. And it was cumbersome and it was painful, but it hasn't really, at the end of the day, it hasn't affected things drastically. What we're talking about here is IFRS Phase 2, which was, and again came out of Europe, which is effectively going to impact the way that insurance companies reserve and price, and how they can price products and how they have to report earnings and so forth. And the way it was originally drafted, and it was to be implemented, it was supposed to be implemented in June of 2011. And if it had been implemented, guaranteed products as we know them would have been devastated, because effectively what they wanted to do, Phil talked about asset liability matching. So, and that's why Canada is able to offer guaranteed products. We have maybe the most sophisticated method in the world. And basically, we take, as Phil said, you take long-term liabilities. You match, if you've got a 30, 40-year liability, you buy a 30-year bond to match a 30-year liability. So you're just working off your spread. You know what you're dealing with. And basically, what IFRS was going to do is say, well, we have to decouple the assets and the liabilities. So you can't. It doesn't matter how you match assets. You just have. It's basically what your liabilities are. And if the market, as you get a volatile market, insurance companies have to keep adapting. They have to keep setting their reserves based on where the market is heading. And when the market's as volatile as it's been, your financial reporting, your balance sheet, your P&L is going to be all over the map, and you're not going to possibly be able to price products. And luckily, the insurance industry in Canada, particularly in the United States, went to them and said, "Whoa, this isn't going to work," and they went, "Yeah, you're right." And so now it's gone back to the drawing board. So something that was supposed to be implemented in June of 2011 is now going to be implemented at the earliest, probably, Phil, what?
2015.
2015.
Widely expected it won't be.
And I think what they realized was that they were pretty much off target on what they were trying to do. And as Phil said, I'm not going to you're not going to see the Canadian government or the U.S. allow anything to happen that's going to turn our industry upside down. So I think it's an issue. We need to be aware of it, but in the short term, it's not going to affect us. In the long term, hopefully, it's not going to have a huge effect on it.
Yeah, I really believe it's too early to tell what the final impact of the IFRS will be. And I don't think it's something you need to really worry at it. Like I said earlier, PAR will likely be less impacted by it because of the volatility in the different funds and ways in the dividend, how you get the returns on the dividend, the interest, the real estate returns, the equity returns, expenses, mortality, et cetera, et cetera. And we hear a lot from advisors. I've heard a lot from advisors where they're saying, you know what, this is the end of guaranteed products. It's the end of long-term products. We're not going to be able to see them again with the IFRS. And I'm not sure I would conclude that at this stage of the game. Consumers want guarantees, and the industry will meet those needs. What you have to remember is, this is it's quite a complicated topic. Now, we're not going to solve it here today, that's for sure. None of us, Paul and myself, we're not actuaries. We pretend to be, but we're not. The way I would best illustrate the issue with the proposal of the IFRS, as we've said a couple of times, that it's not expected to come into play at the earliest between 2015. I've talked about the matching principle. You have an asset, you have a liability, look long term. So if I was to buy a bond today, 10 years out, at 3%, what happens? Every year I get my 3%, record that in earning. I borrow, and I'll probably borrow at some rate higher than the free. So let's say the spreads that we make is 0.5%. Markets move up or down. What happens? Both of those assets and liabilities move proportionally. Not identical, but proportionally. So if I got that investment $100 today, 3%, today's environment, 10-year out, 2 years from now, interest rates go to 6. What happens to my $100 bond? It's worth less than $100. So what the IFRS is saying, the proposal, again, the proposal, we're not there yet. There's lots of work before we get there. The proposal says now you got to record your book value of that bond at less than $100. 96, 95, 94, whatever that number is, but it won't be 100. What was the intent when I bought the $100 bond? I was happy to buy the $100 bond and get my 3% per year for 10 years, and at the 10th year, what was I expected to get back? My $100. That's what I bought for. The fact that interest rates move up and down during that 10-year period, what impact does it have to my cash flow and to the need that I had to do? Nothing. So that's where the proposal between IFRS 2 and what is currently being done in Canada is it doesn't recognize that matching. The fact that you own that bond at 100 and you're collecting your 3% year after year, it has nothing to do whether or not there's a risk there. They're saying it doesn't matter. The bond value today is worth less if you were to buy it on market, therefore you need to record that in your books. And that's the debate. So again, we're not there yet. It's widely expected that this won't come into play before the earliest 2015. And there's lots of discussion being done at the international level. It's not just a Canadian issue. So again, don't have a fear that, don't conclude today, would be my comment, that long-term products are gone because of IFRS. There's lots of work to be done here.
The next question, I'm not sure that we probably have enough time left in the day to fully discuss this, but given the fact that we've had a rationalization of the number of companies in the insurance industry, where do you see the future of distribution going in Canada over the next 5 years? Whose turn is it, Phil? I think
Sure.
you go first.
Well, in my view, the advice channel is extremely important. It's one that's been around for a long time, and I really believe it's going to be one, from my point of view, it's going to exist well into the future. At the end of the day, the client's needs are getting more complicated. The products get somewhat complicated, and so you'll need advisors, now professional advisors that are working in the client's best interest to be able to take and understand their needs, not just push a product, but understand the need that the client is faced with and come up with a solution. So I think the need for the advice channel is going to be there, and we at Canada Life look forward to meeting that need. There is consolidation for sure in the MGA. You've seen a lot of it happening. Even recently, that the activity's picked up a bit. Paul and their merger acquisition with IDC out of Ontario is a good example. Do I see continuation of consolidation at the MGA front? Absolutely. I think it's going to happen. To what level? Who knows? Does it mean that only the big will survive? I'm not willing to say that. I think there's room for the niche players. There will be some small firms, some mid-sized firms. Not all size fits everybody. So I think you'll continue to see consolidation. I don't think it's all you're going to see are, in my view, 3, 4, 5 large MGAs and nobody else will exist. I doubt that will happen. We have on the career side, we have one of our sister companies. In fact, I'd say 2 of our companies, one being London Life and a cousin company, Investors Group as well, where they recruit individuals to come new into the business, and they work primarily with that distribution organization. London Life, the same thing. So I think there's the value, the advice channel will continue to exist well into the future. That's my opinion on that.
So earlier you mentioned actuaries. So Phil's Italian by heritage. You know what the difference between an actuary and an Italian actuary is? An actuary knows how many people will die this year. An Italian actuary knows their name and address.
That's true.
So where do I see the future distribution?
What are you wearing?
Yeah. Black. Yeah.
Graham Boulevard in 15.
Is that a car bomb this morning? Anyways.
He did say it wasn't me that made the call.
Yeah.
I'm off the hook.
No, I think the major change, I agree with everything Phil said. Like the advice channel is becoming more and more important. You know, there are some issues with the advice channel. But the advice channel is becoming more and more important. I think the major change factor we're going to see in the next 5 years is regulation. You know, as I joked a few times, you know, I think it was a year or two ago, there was an article in the Globe and Mail, and it was going on about MGAs and how, you know, advisors are running wild. And I joked, yeah, well, the regulators, they woke up from a 20-year coma and realized that there's MGAs out there. Like, you know, it's just kind of, it's almost laughable for the lack of attention that regulators have paid to the changes in distribution. And now now it's on the front burner and they're trying to work with it. And I understand that, but you know, you've seen the recent, we talked about the recent bulletin from the Insurance Council. And I really think the biggest change that we're going to see in that aspect in the next 5 years is that you know, the biggest concern at the regulatory level is who's supervising advisors, who's supervising the advice. Because with you know, our firm or Canada Life, you know, we deal with independent advisors, and we respect their independence, and we don't, you know, they don't work for us, they're not employed by us. We have no regulatory control over them whatsoever. And you know, so where we're seeing issues in I think the industry today is that it's that small percentage of advisors that don't conduct themselves with having the client's interest first, and it's creating problems and issues for all of us in the eyes of the regulators. So I think, you know, you're going to see a movement towards how are we going to regulate financial advisors, how are we going to supervise them, and how are we going to regulate. Like, to me, selling life insurance should be separated from giving financial advice. The biggest problem I see, it's not people selling life insurance. It's people who have insurance licenses holding themselves out as financial advisors who are selling people Ponzi schemes or real estate deals or whatever. And that's really where, you know, where the clients are you know, losing money and not being served properly. And, you know, one of the other issues is that I think an issue with our industry is, although we don't have enough new blood coming in, we have to find a way to raise the bar as well, so that, you know, so that when people deal with an insurance advisor, they know there's a certain level of competency and knowledge and somewhat fiduciary responsibility. Like, I think that's another thing that, you know, we try to avoid. But really, if you're going to give advice, then, you know, you have an obligation to your client that goes beyond just selling them a product. And I think in the next 5 years, a lot of that is going to, you know, we're going to start to have to deal with those issues. And I think probably everyone in this room is capable of doing it, but I think as an industry we're going to face that. And it's important because, as Phil says, financial advice has never been more important than it is today. And that's why clients get ripped off, because they go to certain people and they want advice, and they get advice that is not in their best interest, in the best interest of the advisor, whatever it may be. So, you know, that's what I see.
I also see, I think, on the IROC firms and the planning firms, you'll see continued growth in those channels as well into the future. And their focus isn't going to only be on the life insurance aspect of it, but rather on, you know, living benefits as well as payout type products, income products for clients. So I think the whole IROC channel and the planning firm channel is growing rapidly, and you'll see some continued success in that channel as well.